How much visibility are you hoping to get from this earnings season, and what will really top your list of concerns or things that you're watching at this point?
For the second quarter at this point in time, there's not a lot of expectations built into the market. I think people understand that there's been some difficulties in the second quarter, particularly with the lockdown that we saw in Shanghai. So now it's really about a focus in terms of where we go into the second half and into next year. If the corporates could give us some visibility and also show some stability in the margin side, I think that would be a relief for the markets in Asia at this point in time.
How problematic could what's happening in Chinese property sector be this time around? I mean, we've seen this crisis really come and go, headlines come and go, and this time around we're even hearing from just average citizens that they don't want to make those mortgage payments. Will this become an issue that could lead to contagion?
Potentially. I think the Chinese real estate crisis is something that has been happening for some time now. We have seen land sales drop to levels that we definitely have not seen since records began. Inventory sales by the existing developers are also dropping off quite sharply, and this impacts the local government finances, obviously. The new change that we see right now is that a lot of the common citizens that have taken out mortgages in pre-sales are now basically stopping the mortgage, as we've seen for reports. And this is significant because compared to the exposure that the banks have to the developers, the exposure the developers have to the mortgages are much bigger. Having said that, I want to take a bit of a pause here to also say that the back book, which is the average loan book that the Chinese banks have, are actually quite robust. So this would probably be loans that they've made in the last couple of years, but for the pre-sales for projects that has now not completed and now stalling. But certainly this is something that is warranting a lot of attention. We obviously seen reports that the financial regulators at the Ministry of Housing has met with some of the banks to discuss how to tackle this issue. So they're taking a very high level of attention to this, and I think they are paying the right attention to this because this is something that could potentially spiral out of control.
In a year where economic and political stability is key, Beijing is really struggling with this very complex macroeconomic picture right now. So how do you assess the risks, particularly given that the ongoing COVID-0 strategy and that economic stability and growth is in conflict with each other?
It is certainly in conflict. On the macro basis, we are definitely seeing the policymaker turning decisively accommodative. We have seen total social financing increasing significantly, and we've also seen fiscal pump priming being prepared. We're now talking about roughly about 1.1 or 1.5 trillion that would be targeted for infrastructure spending, with local government financing bonds being brought forward from next year to this year. So these are the policy that will be supportive and accommodative for the economy in the second half and going into the next year. And the second half is important because the presidency has also made a focus on trying to achieve the targets of 5.5% that was articulated earlier this year. Secondly, I would say the benign inflation environment in China also sets it apart relative to the other major economies in the world, so they can continue to stimulate without much fears about stoking inflation compared to developed economies right now. We have also seen that demand for Chinese goods continue to be robust. We have seen the latest export numbers be quite good, but although the import numbers has fallen off quite a bit. But the final point is obviously that the stimulus and the supporting measures are also conflicting with dynamic zero COVID. As we have seen in various cities, the fears of being a secondary lockdown and the now, shall we say, more normalized policy of regular PCR testing is conflicting with trying to stimulate economic growth. Because if you're testing every 48 hours or every week, this obviously is going to impact people's daily lives, their willingness to consume, and consumer confidence.